Hi there, I'm Mr. Wang here, Chief Operations Officer and co-founder of ANC Group of Companies. Now, in this series of videos, I'm going to cover topics related to transfer pricing. As you may know, there are updates in this year's Finance Bill 2020. The government introduced penalties for non-compliance of transfer pricing where there were none in the past. And we are seeing more and more tax queries raised by the Inland Revenue Board concerning transfer pricing. This shows that the Inland Revenue Board, or the IRB, is taking more interest in this grey area of business tax law. So in this series of videos, we are going to look into Malaysia transfer pricing regime and TP compliance requirements. For multinational companies and larger companies which have related party transactions but have yet to prepare a transfer pricing documentation, you may want to have your documentation prepared as soon as possible. Because from 1st January 2021 onwards, failure to finish the transfer pricing documentation to the IRB will expose the companies to penalty. And there will be a 5% surcharge on the transfer pricing adjustment made by the IRB. We'll look into these newly proposed penalties in more detail later in the video. So let's start with an introduction on what is transfer pricing. Transfer pricing, or TP, refers to intercompany pricing arrangement for the transfer of goods or services that are exchanged between related, commonly controlled legal entities within an enterprise or organization. Ideally, the transfer price should not differ from the prevailing market price, which would be reflected in a transaction between independent persons. For example, within a group of two companies, Company A purchased goods from Company B. The price that is charged by Company B to Company A is referred to as transfer price. So Company A and Company B is having a commercial relationship. So why is the price or amount of which the goods or services that is being purchased by Company A from Company B is scrutinized by the tax authorities? That's because companies use transfer pricing as a method of allocating profits or mispricing amongst its various subsidiaries within the enterprise or organization to obtain tax advantage. Let me share with you an example of how transfer mispricing happens. The biggest e-commerce tech company in the US, which I should not name, was brought to the court by the US Internal Revenue Service, or IRS, in the year 2017 for transfer pricing discrepancies. In 2005 and 2006, the multinational e-commerce company had transferred US $225 million in royalty payments to its tax haven in Luxembourg. But according to the IRS, the royalty payment should have amounted to US $3.5 billion. This transfer pricing adjustment would have increased the multinational e-commerce company's federal tax payments by more than US $1 billion. Okay, so TP only impacts multinational companies. I'm just a local SME company with no company located overseas. TP will no longer impact me, right? Wrong. TP will impact local SME if transfer price between related local companies are seen as having a tax advantage. For example, transacting with related local SME subsidiaries which are enjoying tax incentives or suffering from losses. These transactions can be seen as having transfer mispricing if proper TP documentation are not kept in place. In the example which we have discussed, in order for there to be a TP issue when two companies transact, the company within the enterprise or organization needs to be associated or related to each other. Two companies are said to be associated companies with respect to each other if one of the company participates directly or indirectly in a management, control, or capital of the other company, or the same person participate directly or indirectly in a management, control, or capital of both companies. This interpretation or related companies or companies in the same group referred to in the context of holding and subsidiary company is provided for under subsection 2 bracket 4 of the Income Tax Act 1967. In terms of scope, TP is relevant to businesses with gross income exceeding 25 million and total amount of related party transaction exceeding 50 million. In terms of financial assistance, it needs to exceed 50 million. If your company fall within the scope that I just mentioned earlier, you will have to prepare a TP documentation. If you do not fall within the scope that I mentioned earlier, you are still required to prepare a TP documentation, but you will only need a condensed version of the TP documentation. So the key takeaway here is, number 1, there exists commercial relationship between two companies. Number 2, company exchanging goods or services are related. And lastly, the price of the transaction needs to be at arm's length or market rate. I hope this video will enlighten you on what is transfer price. I'll see you in the next video where we'll look into the guidelines and regulations which are applicable to transfer pricing.